over cost of sales by 100 over 1, and the figures 245 is our gross profit and the 405,000 is the cost of sales multiplied by 100 over 1 gives us 60.49%. Make sure you go to the two decimal places. Don't be tempted to 60.5, leave it at 60.49, and also don't forget your percentage symbol. They're a bit finicky about these things in the exam. For example, if you gave that there as if you gave an answer there of 60.5, you could lose 1 mark for not putting down 0.49, and believe it or not, another one for not writing down percentage. Margin or gross profit percentage then is your gross profit as a percentage of sales. It's the same gross profit, 245,000 over 650,000 by 100 over 1. And again, being careful with our two decimal places and our label, we have 37.69%. It's worth remembering that in exams, if you have the right answer, that's the figure on the extreme right. If you have the complete right answer, you get full credit for the marks. You get all the marks, and nobody looks to the left. We only look to the left when you have a mistake. And remember that the correct formula written down in full, for example, for markup, it wouldn't do to say gross profit over cost of sales. You'd have to have gross profit over cost of sales by 100. The full formula will earn you 3 or 4 marks out of the 8, 9 or 10 going for the question. We have 4 profitability ratios: markup, margin, net profit percentage, and return on capital employed. And our net profit percentage, like we did in the last example, the formula is the net profit before interest and before tax. NPBIT it's called sometimes. And you get that by adding your interest back to net profit. That's why we say the formula is net profit plus interest over sales by 100 over 1. The 10,800 interest was got by checking out your loan, your debentures. They were 9% debentures, I think. I'm just having a look here. Yes, the debentures were 120 grand at 9%, and that would be 10,800. So that's how we got that figure. So it's 70,000 with the 10.8 added back to it as over 650,000. It was 12.43% for our net profit percentage. And our return on capital employed, called the primary profitability ratio, that's because it's the main profitability ratio, is net profit plus interest over capital employed by 100 over 1. Now, unfortunately, it's the same figures for return on capital employed, because in the balance sheet, our capital employed just happens by coincidence to be the same as the net sales figure in the trading account. So we have 12.43%. Two observations about the return on capital employed. We'd like to compare it with last year's figure, which we don't have, but let's pretend last year's was 10%. We would say that's a 24.3% improvement in profitability. Check those figures out, please. Don't forget, in these videos, you can go back, you can go forward. So if it was 10% last year and it's 12.43% this year, can you see that the correct thing to say is profits have gone up by 24.3% and not 2.43%? Moving on then to look at liquidity with just those two ratios, the current ratio and the asset test. The ratio of current assets is to current liabilities. Write them down that way, current assets, colon, current liabilities. The figures, 140,000 is to 70,000, or 2 is to 1. We know that's on the high side of the best ratio. Your ideal recommended current ratio is anything from 1.5 up to 2 is to 1. So 2 is to 1 is fine there. The asset test, or the quick asset ratio, or the liquid asset ratio, that's the most important measurement of liquidity. It's current assets minus stock and prepayments, but typically in these questions there are no prepayments, and that's why we end up saying that it's current assets minus stock is to current liabilities. Our closing stock, of course, is 85,000, so that leaves us with 55,000 worth of liquid assets to cover current liabilities of 70,000. So our asset test is 0.79:1. Remember what that means? It means that for every euro in debts falling due, current liabilities, we have only 79 cents in liquid assets with which to pay them. So you'd say this firm has a liquidity problem. It can't pay its debts as they fall due. The recommended asset test is 1:1. Under 1:1, and you can't pay your debts as they fall due, just like this firm can't. And over 1:1 is looked at as being a bit wasteful. Stock turnover, again, measures the number of times in a year that you sell your average stock. It's cost of sales over average stock, and it's a simple average got by adding your opening and closing stock and dividing by 2. A good average, a better average, would be if you could get the closing stock figure for every month, add them all up and divide by 12, but that isn't possible in these questions where we only have opening and closing stock. So we got an average of 82,500 divided into 405,000, the cost of sales, giving us a stock turnover of 4.91 times. Don't leave it at 4.9. Don't leave it at 4.9 times. It's 4.91 times. And remember, that's not as good as if you had 5 or 6 last year. It means we're selling our stock more slowly, but it's better than, for example, if you had 3.5 times last year. Finishing it off then with ratios 8 and 9, we're looking at our credit control, period of credit allowed to debtors and the period of credit received from creditors. And ideally you want to get your debtors to pay you as quickly as possible, and then pay your creditors a little bit after that. Now remember that credit sales are caused by that debtors are caused by you making credit sales. That's why the formula for period of credit allowed to debtors is debtors over credit sales by 365. In our example here, it's 80,000 over 650,000, the 80,000 being the debtors figure in the balance sheet, and the 650,000 being the credit sales by 365 for days. If you wanted the answer in months, you could simply multiply by 12, and that gives us 44.92 days. Now, this is one of those cases where it would be okay to round off that and say that our debtors are taking approximately 45 days. It's a bit too long. Irish firms typically allow 30 days credit. Now, your customers, as is happening here, will take more than the 30 days, and it's up to you then to try to get in more quickly. It's a question in business then as to how you can get your debtors to pay more quickly. The period of credit received from our suppliers, creditors are caused by credit purchases, and that's why it's the 2 of those in your formula. So it's creditors over credit purchases by 365, or again by 12 if it's months you're looking for. We have 70,000 over 410,000 by 365, showing that we're taking about 62.32 days to pay our own suppliers, which of course is way too long, but that's what this figure is throwing up. Again, there's no harm in calling that 62 days, but don't be rounding up your other percentages and ratios. It's okay to round up to the nearest day the period of credit allowed to debtors and the period of credit received from creditors, but not other ones. Don't forget you can come back to this video anytime you want to by following the link. And don't forget also that you can jump to different parts of the video by moving the controls. That's it for now. Thanks. Bye-bye.